battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 43 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. We so appreciate you coming back each and every week to watch the show. If you happen to be watching on YouTube or Apple or Spotify, please feel free to hit the subscribe button. It would help us out and gets the show to more and more people. Share it with your friends and family. Get them the clarity and confidence. The good news, we are going to be covering lots of data today. All of the good news that is going on beneath the surface. Following up on last week's episode, we're going to talk a little bit about that as well. This week's episode 160, not a Fugazi. We'll get into that in just 1 second. I do want to remind you, Investor Day 2025, coming up very, very soon. Almost sold out, 80% full. This is probably one of the last times we'll be talking about it on the show as a reminder. So if you've been thinking about it, you've been wanting to come into town for this for a number of years and just haven't been able to do it, get this one on the calendar. You can't miss it. Dr. Ed Yardeni. We've got Andrew Opdyke from First Trust, the Family Office panel. Don't miss Investor Day. Things going to be full probably after we send the next email out, which will be in the next week or so. So get that on the calendar. And we've got a couple awesome episodes of Bullish coming to you very soon. We have Bob Stein from First Trust as well, who is a political economist. He's going to tell you a little bit about what's going on at DC. He actually lives in DC. He'll give you the inside scoop on how the election is going and where he thinks the results are going to end up and how that affects the economy. So that's the next episode of Bullish. And then the episode after that is a very special guest. Not going to tell you who it is quite yet. Want you to have a nice surprise. You're going to be very happy with the episode 22 of Bullish. So don't miss that one as well. And we'll have some awesome content coming to you very, very soon. There, we did cover the NVIDIA Q2 2025 results yesterday that came out. Had great results. NVIDIA is doing very well. Stock's reacting a little bit negatively here today. Nothing to worry about. I think the stock's going to do just fine long-term. Not investment advice, just commenting on the results from yesterday. But we did a full episode on that, and it's on YouTube. So go check that out as well. So we'll jump in. Not a Fugazi. You're going to remember from The Wolf of Wall Street, if you ever saw that movie, when Matthew McConaughey, Jordan Belfort are at lunch. It's one of Jordan Belfort's first days on Wall Street, and Matthew McConaughey's character is telling him it's a Fugazi, it's a Fugazi, it's a woozy, it's a wazi, it's fairy dust. It's not real, talking about the stock market. And you've heard me say this so many times on the show in the past, that could not be further from the truth. It's not a Fugazi. The stock market is not made up. It's not a fantasy. What is the stock market? It's like Dr. Jeremy Siegel has told us in the past that stocks are a claim on real assets. And so when you own stocks, when you own equities, what do you own? Well, you have a tiny little piece, true, but you do have a piece of these real companies and their assets. You own a little piece of their balance sheet. You have a little bit of their property, plant, and equipment, their real estate, their cash, their goodwill, their intellectual property, and you have a small interest in this company's real business. And real assets in times of inflation, when times get tough, real assets do well. But nobody thinks about stocks in the sense of real assets. Everybody thinks about real assets being real estate. So one of the ways that I think is really helpful to understand stocks and to really understand what you own, when you have a company like NVIDIA in your portfolio, you have a company like Apple, or you have a company like Microsoft, these incredible, strong, great businesses. You've got Procter & Gamble, you've got ExxonMobil, you've got all these insane, just hard to replicate brands in your portfolio, is you truly do own a very unique, one-of-a-kind asset. And it's very similar to if you go downtown Chicago, or you go to New York City, or you go to some of these major cities, or you see this beachfront property somewhere in the United States, whether it's South Carolina or California or Florida, like West Palm Beach in Florida, that's highly valuable. Same concept goes for equities. These assets, when you get beachfront real estate in Malibu, right on the water, or you're right on the water in Palm Beach, it's hard to replicate these assets because they just don't exist everywhere, and there's limited supply and lots of demand. Well, think about your stocks in the same way. How hard would it be for us to replicate Apple? How hard would it be to replicate Microsoft? How hard would it be to replicate Google? These assets are very, very tough to replicate. Now, sometimes if stocks get to the point where it's even too concentrated, it's called a monopoly. And we do see the government break up monopolies from time to time. But that shouldn't scare us either. If you think about the Standard Oil days with John D. Rockefeller, they said, hey, John, you got to break up Standard Oil. It's too powerful. It's too much of a monopoly, which was kind of by design, quite frankly. But when they broke up Standard Oil and it became Exxon and Chevron and all these different pieces, those pieces today are now worth way more than Standard Oil ever would have been worth as one entity. And so the reality is of where we're at now in the stock market is when you get into the biggest and best names and you look at the best companies that are trading out there, the strongest, most resilient American brands that have done a nice job managing through COVID, that didn't take on tons of debt, that didn't take on lots of risk, they're in such a good spot today. It's hard to say that we're going to have massive, massive issues when you look at the best versus the rest. And I've been trying to call out to you this difference with high quality versus low quality. You're seeing this with the S&P 500, which is large cap stocks versus mid cap and then versus small cap. Large caps this year are up almost 19% for the year. You have mid caps up about 11% for the year, and the small caps are up just about 8%. So not bad returns for mid caps and small caps, but we've been saying consistently that the large caps tend to outperform the mids and the smalls when you go through these environments where quality matters. And it's not to say that every company in the S&P 500 is going to be a great investment or that it's worth owning for the long run, but it's just to say that during times where you have high inflation, you have high interest rates, and you have two companies, all else being equal, except one has billions of dollars in cash and reserves and one has billions of dollars of debt on its balance sheet, that higher quality company with the cash is going to outperform. And so that's what we've seen. Now, the narrative all year has been that the entire stock market is only being driven by 7 stocks. That could not be further from the truth. And this is, again, why you got to get on the show every week. This is one of the only places you're going to hear the data, the math, the statistics of what's actually going on beneath the surface versus the media doom and gloom and all the hype and all the nonsense. Let me read to you the top 22 names in the mega caps and large caps for fiscal year, for year-to-date 2024. NVIDIA is up 146%, the number one performer, as you can imagine, in the mega cap space. But the number 2 is not a AI company. It's actually Eli Lilly, which is up 63%, a company that is producing pharmaceuticals. You've got Facebook, which is now called Meta, up 48%. That is AI related. But then right after it, number 4 is not an AI company. You've got Walmart up 44% year to date. And I think if you went into 2024 thinking the number 4 performer in the mega caps would be Walmart, you probably would have laughed me out of the room. You would not have believed that. That's the reality of where we're at. Then we do have another AI company mixed in there. Number 5 is Broadcom, up 44%. We've got Netflix up 43%. But number 7, American Express, not an AI company, is up 38% year to date. The next one's not an AI company. It's Costco. Costco's up 36% year to date. Then you got Oracle. You could argue that some of that is AI related. That's up 33%. Then it's Berkshire, not AI, 31% for the year. Here's one that would surprise a lot of us, is a utility stock to be one of the best performers in the mega caps year to date. Nextera up 30% for the year. You've got JP Morgan up 30%. You have AbbVie, the pharmaceutical company, up 26%. You've got T-Mobile up 25%. You've got Coca-Cola up 21%. You've got Caterpillar up 20%. You've got Apple up 20%. Listen to these next ones. Bank of America up 18%. ExxonMobil up 18%. Procter & Gamble, they're making toothpaste, deodorant, mouthwash, not AI. They're up 16%, for 2024. And then Wells Fargo up 16%. Everybody thought Wells would be done. And again, I'm not telling you to buy any of these. I'm not saying these are screaming buys or sells or anything like that. I'm just reporting the facts to you that this is not just an AI rally. This is not just 7 stocks. There's a lot of breath going on in the market. And now I have kind of ripped on mid caps and small caps, not in the sense that you can never make money on them, just for our purposes. Our purposes with our clients is to protect a lot of their capital, not to take risks that we don't need to be taking, excessive risk. I think that exists sometimes with mids and smalls. But when you're sitting on mid caps up 11% for the year, what's so bad about that? What's so bad about small caps being up 8% for the year? That's not that bad. Those are pretty good numbers. When you get into some of the countries out there, you start to see the difference. I've talked about the difference between good policy and bad policy when it comes to investing. And it's not all about Democrat, Republican, right or left. It's not about any of that. It comes down to policy. If you've got good policy, what happens is you see the stock market do well. Look at Argentina here. Argentina under Javier Milei is up 26% year to date. Good policy drives good results. You have Mexico on the other side of things going more towards a socialist push, down 21%. So why is the stock market up in a midterm year so much, which is actually a little surprising? I think it's because the market is predicting one of two things to happen here. Number one, it's going to be that the Republicans sweep and they win everything. They take back the presidency, they keep the House, and they win back the Senate, or that there's at least divided government. And I'm not endorsing any of these things. I'm not telling you what I want to happen or anything like that or my political leanings. I'm just telling you markets like the setup for November. So you can disagree with me. You can say, Nick, you're wrong, and here's why, but you can't disagree with the market. The market is telling you, take emotion out of it, take the Fugazi, Awoozi, Awazi off the table for a second, and just remember markets are a forward-looking indicator of what's to come. Now, can markets be wrong? Obviously, but over the long run, markets are directionally right. And a lot of people have really goofed up their portfolio. They've lost a ton of money trying to outsmart the market. And one of the things that you see, great quote from Peter Lynch, is that a lot more money has been lost preparing for a correction than in the actual correction itself. And so one of the things that I would just encourage you to remember, which may sound like a slight contradiction, is that last week rather, I did an episode called It Ain't Over Yet. And then this week we're saying it's not a Fugazi. So it seems like two different statements that we're making, that we're bullish, but we're also bearish sometimes. Well, the reality is I do think we're due for a correction, but my broader point is you trying to prepare for that correction, even if we do go down another 10%, like we almost did a few weeks ago, is a horrible, horrible strategy. Nobody can predict the short-term whims of the market. Nobody can predict what's coming on a day-to-day or week-to-week or month-to-month basis. And the best answer, you may not like this answer, but the best answer is that you have to stay on your plan. You have to stay on the course. So yes, I think markets are probably due for a correction in the short term. I do think we're going to probably retest that 5,200 point zone on the S&P, but that's not to say that the sky is falling, the world is coming to an end in the long run. And who knows, maybe I'm wrong. I hope I'm wrong. I hope we don't have a 10% correction. I'm just preparing you for the possibility that there usually is some more volatility. We're not quite out of the woods in a midterm year. But going into next year, going into 2025, that's the first year of the cycle. That year tends to be very, very positive for markets. So all of this to say, you can see the breadth widening out. You can see these companies doing well. Yes, we're seeing a little bit of slowing growth. Yes, we're going to see a little bit of a difference in the growth rates here. But we have a wonderful backdrop still, I believe, for the highest quality U.S. companies. And so I would encourage you, stay on your plan. Don't be alarmed if you see a little bit of a pullback. Don't be alarmed if there's a correction or if we retest some of those lows. I think in the long run, you're going to be very happy you stayed bullish. The reality is we are going to hit 6,200, 6,300 points on the S&P. And if I pull out the crystal ball here and had a real crystal ball, maybe I could tell you exactly when we were going to hit that. But the problem is none of us really know. We don't know when we're actually going to hit that 62, 6,300 point zone. So what you have to do is this. You stay on your plan. You rebalance along the way. There's still a number of companies that are worth buying right now. There's still a lot of great American stocks that, again, that are hard to replicate. Think about them like real estate assets where they're almost irreplaceable. It's very hard to replace a lot of these companies and the value they add. And so because of that, you would be absolutely insane. You'd be completely out of your mind to sell these stocks. Be prepared for a correction mentally. Be prepared for a rainy day. But like Warren Buffett said, most things in life, when bad things happen, everyone says, don't just stand there, do something. Remember, Warren Buffett says, do the opposite. just sit there and don't do anything. That's the reality of being a good investor. So we're going to cut off short a little bit today on this week's show, but I just wanted to encourage you to stay the course. Go watch that full show from yesterday talking about NVIDIA's earnings, and we'll be back next week with you for episode 161. Register for Investor Day, and we've got some wonderful episodes of Bullish coming up to you very, very soon. Thank you for being with us. Don't forget to subscribe. We'll see you next time.